Right, okay. Good morning, good afternoon, and good evening to you all. Happy New Year. I hope you all had a really nice break over the holiday season and you're ready and raring to go for 2026 and your trading and you have a good, successful year in your trading. So I'm Ross Maxwell. Welcome back to the Trading Vault. We've got a really exciting session with in store for you today. It's all focused on gold, and we're going to do some live trading and stuff as well, looking at some real charts. Got to go through different time frames, looking at different opportunities in the market for gold at the moment. But if, as always, if you could just introduce yourself, maybe make sure that you can let me know that you can hear me, see me okay, see my screen, and just introduce yourself. Tell me where you're coming from, your level of experience, what you're trying to get from today's session. That would be really interesting and really good to hear. So, as always, like I say, so we're over the sort of coming webinars. What we're going to do is take a slightly different approach rather than having all education led or solely focus on live trading. We're going to mix the two up. We're going to have a little bit. We're going to have a particular asset class or a particular instrument that we're going to focus on. We'll have a little bit of education around that instrument, and then we're going to do some live trading as well. So we're going to change this up over the coming months as well in the coming sessions, so that you can see that and hopefully get some value as well. And as I say, today is all about gold. So we're going to do a live gold session. We're going to have entry, exits. We're going to talk about risk. Obviously, gold is a very fast-moving, volatile market, especially in the current environment that we find ourselves in, with sort of so many sort of geopolitical risks, so many geopolitical shocks. You know, the uncertainty around inflation, interest rates, all of this stuff has meant that gold has been very volatile. It's been obviously on a really bullish run, and as we speak, it's still sort of making new all-time highs. So it's a really hot instrument, really hot asset class, and we're going to talk today about how to and hopefully show you how to take the advantage of that volatility and of the opportunities that gold has in 2026. So. Um, Good morning, everyone. Lots of people coming in here. I've got 115 people on already. We've got people here from Africa, from Holland, from Europe, from the Philippines, Sussex, UK. I'm in Kent, John, so just around the corner from you, not too far. UK, Malta, Canada, Switzerland, so all over the world, which is great. New York. Canada, Scotland, Greece, yeah, lots of different, lots of people coming in from lots of different places. So, thank you very much for taking the time to be with us today. Let's get into this session. If we have any questions as we go through the material or as we're in the live trading, please do fire away. Please do ask. I will answer as many questions as I possibly can. We will potentially, if we're trying to get through the session, we will have some time at the end for Q&A as well. So if I do miss a question, please don't take it personally. We'll have time for that towards the end of the session as well. So let's jump into the trading session as well. So. First of all, a quick introduction to myself. If you have been coming on these sessions, you obviously probably will know who I am, but I think there's quite a few new people here today. So just introduce myself. My name is Ross Maxwell. I am the Global Operations and Strategy Lead here at VT Markets. I provide high-level education for traders of all levels, from beginners right the way through to experienced professional traders. I work with traders from all walks of life, all different sort of skill levels as well. I am a professional trader myself. I'm also an investment manager, and I have been trading the markets for more than 20 years. I started my career in London and spent some time in Hong Kong, and for the last 12 years now as an independent trader. I'm also an award-winning trading coach and mentor, and founder of Keyzone Traders, which is an online trading education company. So that's enough about me, just a little bit about me. Let's get into gold. As I say, this is going to be purely focused on gold today. We'll look at different asset classes as in future sessions, but we're really wanting to make sure that we focus on gold because it's a really hot instrument, one that most people are trading, both from a speculative point of view, but also from a longer term investment point of view, in terms of sort of like that safe haven, that hedge against inflation, that hedge against geopolitical risks, and that portfolio, you have to access in your portfolio. So let's talk about gold. So gold has been seen as a store of value for thousands of years. It is a mainstay of the whole financial system. Okay, this predates the markets as we know them. Gold has always been a store of value value in the financial market. It's been around as long as a financial system has been in place. It is viewed as a safe haven asset during periods of financial crises and geopolitical instability. So when we see this sort of volatility in sort of equity markets and currencies, often investors will take their money out of that and put it into gold because it's seen as a more safe asset that will store its value and avoid those sort of like volatility swings. It's extremely highly liquid with tight spreads and can be traded 24 hours a day across global markets. So it's very accessible for all traders, whether you're retail, whether you're institutional. It's highly accessible, and the tight spreads make it a viable and attractive asset to trade as well. So as I say, it's got easy access for retail, institutions, and central banks, and is standardized globally in US dollars. So again, it's linked to the US dollar. It is priced in US dollars, so it is easily accessible again across for all types of traders. Okay, so speculative traders. Okay, speculative traders like trading gold because it has opportunities presented due to its volatility around macro news events. So it's very when there's big news events going on in the world or globally, gold will become volatile and will react to that. Okay, so when there's fundamental news releases, whether that's to do with the economy, whether that's to do with geopolitical tensions around sort of trade wars with the US or China, the ongoing crises between the US and Venezuela or Iran and that sort of thing, gold will react to it. So it provides volatility around those macro events. It's very strong technically. It respects support and resistance levels extremely well. It's an asset. For those of you that have been as part of my part of these webinars, you will know that I base a lot of my theory and my trading decisions around key support and resistance levels. And gold is one of the main assets that I trade because it does respect those levels extremely well. You have high leverage available in futures and CFDs with tight spreads, making barrier to entry extremely low, and available tools I mentioned for retail traders as much as institutional traders. Retail traders do have easy access to be able to trade gold. And not just the gold physical bullion, but through sort of ETFs, through CFDs, through futures. We all have access to be able to trade gold. It's highly correlated with movements in US dollars and real yields, and it is good for short-term and momentum strategies. So it's a really good instrument for speculative traders to trade. Now, obviously, speculative traders and investors, longer-term traders, they have different aims and different goals through trading gold. So you need to be aware of what your goal for trading gold is, and then you need to adjust your approach to trading gold accordingly. So investors like gold due to its ability to protect against inflation risks. It has low correlation to equities during times of stress, creating a safe haven asset appeal, like I say. So when something happens, like during the global financial crisis, for example, or through COVID, when the stock markets were getting hit, companies were really struggling through earnings and stuff like that, gold will actually benefit in those sorts of times because it is not correlated. So the investors are turning into a risk-off environment. They're taking their money out of riskier assets, such as your equities, and they're moving it into something that they see as a safe asset that will store their value and smooth out that equity curve and take away from that volatility. And gold is seen very much as that because, as I say, it's a mainstay of the financial system. It's been around for thousands of years since the financial system was put in place. It performs well when other markets are in times of crisis. It protects against US dollar weakness, and there is no credit or default risk. Okay. Now, when does gold perform well? So we need to, again, this goes into just understanding when we're likely to see a bullish environment in gold, which we've seen now for the last sort of 18 months or so. We've seen a really strong gold market. High or rising inflation environments, and we've seen that over the last couple of years. Certainly since the Russian invasion of Ukraine, that's when the high inflation started. Falling real interest rates. We've now started to see the Fed and global central banks cut rates slightly. So we're still trying to work out how quickly they're going to cut rates and whether it's going to cut rate further. But in times of falling real interest rates, gold will perform well. If the US dollar is weak, gold will become cheaper because it's linked to the US dollar and therefore it becomes more attractive. If there's geopolitical instability or war, again, moving away from riskier assets into gold, which is used as a safe haven asset. When the financial system comes under stress through like banking crises, sovereign debt concerns, obviously the global financial crisis was a good example of that. When we see loose monetary policy such as rate cuts and quantitative easing, and generally speaking, when there is a general risk-off sentiment in the market, when something's happening where investors want to take away their capital from riskier assets such as your equities, and that they will pull it out of those and then put it into gold to store the value of their capital. So when will gold perform poorly? When we see rising real interest rates, when we've got a strong US dollar, it's basically the reverse, obviously. So when we've got stable economic growth with low inflation, bull markets in the equities, again, so it's when that's a risk-on sentiment, because investors will take their money out of gold because they want to take advantage of the bigger gains available in more volatile and more riskier assets such as your equities and stock markets. Periods of tight monetary policy and aggressive rate hikes or quantitative tightening because real yields then rise in riskier assets, so they're going to store their value there and take advantage of the interest rates at in those asset classes. When there is strong confidence in fiat currencies being your US dollar, GBP sterling, euro, those sorts of things, and as I say, when there is just generally a risk on sentiment in the markets. What is going to drive gold in 2026? So traders and investors should watch the following for drivers of gold prices in 2026. So the timing and pace of global rate cuts, particularly from the Fed. Any policy shifts from central banks, including central bank buying, especially from sort of emerging markets. US fiscal deficits and the overall debt in the US. De-dollarization trends, demands from ETFs and institutional investors. Geopolitical tensions, which are obviously ongoing. US dollar trends, so keep a close eye on the US dollar. Obviously, there's a battle between sort of the Donald Trump and sort of like the Fed at the moment. Donald Trump wants the Fed to cut rates. The Fed want to sort of like offer a more rational thought process around balancing that inflation against sort of global GDP and domestic growth. And just sort of like over the weekend, you've seen the High Court goes, or the Justice Department go after Jeremy Powell, and he's saying that that's linked to Donald Trump trying to put political pressure on the Fed to lower those rates. So that's going to be a really key sort of trend for 2026 and generally speaking over the rest of Donald Trump's presidency. And then obviously any indication of any further inflation issues. Inflation has come down, still sticky in places. If we start to see any sort of increase in inflation due to any sort of trade wars or tariffs or anything like that, then that could also impact gold price in 2026. So besides the geopolitical stocks, another major driver of gold and gold prices that can move it is the earnings season. Now, for those of you that don't know, the earnings season is when listed companies, especially in America, release their company results. And most traders think that earnings season is only about the individual stock prices releasing their earnings. But actually, the shocks we see in, say, for example, like big tech, which is very much a driver of the equity markets at the moment, they don't stay just in the stock markets or the equity markets. They do come through the entire financial system, and therefore they will impact gold as well. So when we get an earnings shock, so say a major tech company misses its earnings numbers, then that filters through to investors, and investors will get nervous, and that causes the volatility to spike, and that then usually means that the market starts to reprice interest rates. starts to think that the Fed might become more dovish, and then that can cause Treasury yields and US dollar to drop, and then because the gold price is linked in dollars, all of these sorts of knock on. It's like a domino effect, right? All of these things knock on, and therefore gold is impacted because gold doesn't pay a yield. It becomes an attractive liquidity provider in that scenario because it's the store of value. In fact, in 2025, gold jumped nearly 2% on some days when those big tech companies missed their earnings. So it's a really important time. It's a really important time in the markets especially when these sort of big tech and banking companies release their earnings to create some of that volatility, especially for sort of speculative traders in gold. So we want to watch out for the US stock markets when you're trading gold. We've got the upcoming earnings season towards the end of January. The week starting 26th of January, we've got Microsoft, we've got Meta, Tesla, Amazon, Apple, and Intel all releasing their results that week. So, as I say, these are the big companies releasing their results, and that can, if there's sort of like a big miss on expected earnings, that can create that volatility in gold. So, for you, I guess the takeaway is don't look at gold in isolation. It's not just about the simple supply and demand or what a single government does. Gold is sort of like a part of the whole financial system, and any sort of impact in any part of the financial system, generally speaking, comes back to impact gold, maybe even more so than other asset classes. So uh, especially look out for stocks, and when the earnings is strong, US dollar might strengthen and therefore gold might be slightly bearish and vice versa. So keep an eye on the S&P 500 to gold ratio. That's another little trick just to keep an eye on that. But VT Markets, we have published a full deep dive article on our website that breaks down how to trade gold during the earnings season. It covers specific triangle relationships between, as I just mentioned, in much more detail. So please do give it a read to help structure your trades for this sort of earnings season that's coming up towards the end of January. And the events team have kindly posted a link to that article in the chat box so you can access it there. Please do look at that. It will give you some good pointers and information around trading gold through the earnings season that's coming up. Okay, and then finally, obviously, the earnings season is coming up, and we have the heat of the season is coming up between sort of mid January and mid February, and you can see there that we've got the dates of some of those really big companies that we talk about that can really influence the movement of gold prices. So if you're planning to trade the company releases, you'll definitely want to take advantage of our upcoming cashback campaign. So during this earning season, during the period when you trade US stocks and indices, you get to earn cashback on top of your profits. So if you hit a certain amount of trading volume, you get to earn 2 times your cashback. So in addition, VT Markets offers $0 commission for US stocks. So please do join the campaign to really power up your trading during this earnings season. And again, the events team has kindly put in a link to open a live trading account where you can get your cashback trading the US stocks through the earnings season from the 15th of Jan to the 14th of February. Okay. Ajay, the events team have put the link to the article, just a couple of posts above. It says the earnings season gold article. You should have that there for you to access that. Okay, guys. So, any questions in regards to that part of today's webinar? That is sort of the information-led part of the webinar. We're going to go into the charts now. So please do let me know if you've got any questions or want any information around that part of it before we sort of jump into the charts and show you some sort of levels and how and opportunities in the gold market at the moment. So bear with me 1 second just while I get my trading screen up. Okay. And then again, if we could just quickly So Shivam, how to deal with negativity? Do you mean sort of negativity in the gold market or negativity in terms of like from a personal point of view, like mindset? Um, but yeah, can you, if everyone could just please confirm again now that they can see my screen, which should be a gold chart that you can see. Okay, Shivam. I mean, talking about mindsets and stuff like that, I think we need to cover that in another session. Like I said, I really want to keep this one focused on gold. Um, we have done previous sessions on mindset, so you can access recordings to previous sessions to help maybe with that. But yeah, for sure we can cover that in another session. But today, really want to keep this session focused on topic, which is on gold. Okay, team said Conway says that a web server there's a web server error on the links provided. If you could please just confirm the links, if that's okay. President Nixon took US dollar off the gold standard back in 1971, so why US dollar still has any real value, even just society norms or what? I mean, yeah, I mean, why does US dollar still have any real value? I mean, you have seen sort of some de-dollarization trends, but ultimately the whole financial system is still linked to the US dollar, so it does still have value. And you know, especially with gold, gold is priced in US dollars. You know, a lot of people hold a lot of countries, companies still hold US sovereign debt. You know, it's still the mainstay. The US dollar and the US economy is still the mainstay of the financial system. You know, a lot of companies still trade in US dollars, so they have US dollar exposure. You know, there is still so much linked to the US dollar in terms of the global financial system. So, um, so Shirley, do you think this week gold will continue to be bullish? We will. Let's look. We're going to look into the charts now, so we can look at that. How can we trade something which is only going up? Swing traders' point of view. Yeah, we can cover that again, Benjamin. No problem. Um, there's a lots of chat about a big pullback in the markets this year. How will that affect gold if it happens again? Let's go through the markets now and actual prices and stuff like that, and we can talk about corrections and things. So Trevor, it's a really good question. You know, some people are talking about like 25% corrections and all of this sort of stuff. And don't get me wrong, it is not beyond the possibilities that there's going to be a deep correction in gold. You know, we've seen a really strong push in the markets, especially in gold. But let's put it into perspective. Let's talk about, you know, just because somebody says that and there are arguments as to why that's going to happen, at the moment there is no sign of that pullback happening. We're going to talk about, you know, being able to try and identify the market communicating to us if that is going to happen. You know, we don't just think, you know, somebody says that or, you know, market's been bullish, therefore it's got to have a correction, therefore it's got to have a deep correction. Let the market communicate to you before you start acting on it, because otherwise that's when you get into trouble. Because at the moment, as you can see, this is a gold daily chart. There is absolutely nothing to suggest in this price action that there is going to be a correction right now. You know, even now you know, you start talking about engulfing candles and stuff like that. You get one engulfing candle, you know, and then it just goes bullish again. Really strong negative candle, bit of a pullback, turns bullish again. You need to be able to understand the market communications, and therefore once that that really turns, then you can start thinking about corrections. So you know, if we just sit there and look at this from a higher time frame point of view, okay, so we'll do sort of like some sort of higher time frames. We'll look at the daily, maybe the 4 hour, the hourly, and then sort of like a 5 or 15 minute chart, just to give like a scope of different time frames and the opportunities on them. But at the moment, somebody asked about do I think that gold would continue to be bullish this week? Obviously, there's you know, no crystal ball or anything like that. But if we sit there and think back around the drivers of gold and what will make gold bullish, and we look at that chart, there is nothing to sit there and say at the moment that gold will not be bullish this week. Okay, we're making new highs, we're at the top. There's geopolitical tensions going on. We've got this sort of like, potential US strikes on Iran being talked about, the ongoing Venezuela stuff. You've got Russia, Ukraine, there's so much going on geopolitically that actually, yes, people are still pushing into gold, and there's still nothing in this sort of price action which would suggest that gold is going to have a deep correction this week or going to be bearish this week. If we're looking at this chart, okay, so we've got gold again, clearly bullish chart. Now, you're talking about sort of corrections from here, okay? So we're at 4,600. So if you're talking about 25% correction, 25% of 4,600 is what, 1,150, right? So you've got to take 1,150 points off of that. You're looking at 3,450, right? 3,450, which is all the way down here, right? Now, if we see a 25% correction in gold, this actually ties in with a really, as you can see, really nice support level. So if you do see a 25% correction in gold, it's actually a really good time to buy from an investor's point of view. Okay, so from from an investor's point of view, or when you're trying to put gold as part of your whole portfolio, your strategy is going to be slightly different to a speculative trader. You may need to just buy gold to keep your portfolio weighted properly with gold, okay? Or you might need to do it as some sort of hedge because you've got like exposure or risk within other parts of your portfolio. So when when you're doing that, you may have to just buy gold even at the top, okay? But one of the best things to do is to dollar cost average in. And if anyone's not aware of dollar cost averaging, dollar cost averaging is where you just buy in tranches. So say you've got to buy, you need to buy 5% of your portfolio, of your capital, put 5% of your capital into gold, rather than just going, right, okay, well, I need to buy 5% here at 4,600, just putting 5% in, and then seeing the market have that 25% correction. What you can do is you can go, right, okay, I'm going to buy 1% now, I'm going to buy 1% in a couple of weeks time, a month's time, whatever your time horizon is, or at a particular level, and just layer yourself in. So if the market does pull back, you can take advantage of lower pricing, but if the market continues to push higher, you are still participating at these levels, and you just average in. It's just a way of averaging out the way that you get in, and just reducing some of that risk in terms of just getting in now and that. But obviously speculative, you need to approach slightly different. You need to wait for those pullbacks to get long, because you're doing it from a speculative point of view. You need the market to move in the direction for your trade to be profitable. Okay. But if we're looking at higher time frame opportunities, if we do see that bigger correction of 25%, that's a really good opportunity, even for sort of like longer term swing traders, to get long at around these levels, because that there's technically a resistance level there, or a resistance level which could now turn into support. If we look at a higher time frame, pull back to that area there, the market's still structurally strong in that area. Okay, so it would technically be sound. It would contextually be sound, and you would have had a strong 25% pullback. So there's a lot of reasons why that area around 3,450 to 3,500 would be a good area to buy from a higher time frame point of view. Okay. We also have some strong support in here, and this level around here. So again, from a higher time frame point of view, until we sort of start breaking these sorts of levels, and maybe even this level in around here, again, we've got, if we go back to our support and resistance levels, we found support here. What is that? That's a previous resistance level. Until you start breaking here, right? So I would sit there and say this market is bullish uh, on all time frames until we start breaking this zone here, which is around 4230 to 4280, right? Um, then we have this level of support here. Again, until we start breaking that level here, I don't see some bigger 25% correction happening. If we start breaking this level here, then that brings that deeper correction into play. There is nothing to sit there and say that if we like, there is quite possibly going to be a pullback in gold this year. Okay, it is just from profit taking. If there is any sort of change in any sort of geopolitical tensions ease, earnings seem strong, anything that sort of slightly turns the narrative back into a risk on sentiment, you're going to see profit taking and you're going to see gold correct. But even a correction back to this 3008, sorry, my eyesight's really bad at the moment, 3880 to 3930, that's sort of like a 700 point correction, which is what, like that's sort of 15% correction, right? So even that is a substantial correction that might be enough. That just because there's going to be a correction doesn't mean to say that is going to be a 25% correction. You might just see a sort of 10-15% correction, which would be sufficient before we move higher again. So again, it's just being aware of these daily levels, and being aware that until we start breaking these levels, you don't see that deeper correction coming into play. Okay, and just because you start seeing a correction doesn't mean to say you're automatically going to get that 25-30% correction. It might just be 10-15%. So it's being aware of the levels, being aware of the areas in the market that could actually that you need to break before the corrections come in bigger. So Shirley says maybe there's a possibility to reach 6K. Again, um, let's be a little bit realistic about this in terms of where we are. We've seen a huge increase. Even in 2025 alone, what was our increase in 2025 alone? So 2025 alone was, what's that? Over 60%. I think it was 65, 70% nearly. To get to 6,000, you need another 33% increase. Okay. Now, is that possible? Of course, it's possible. There's a lot going on in the world at the moment which could make that happen. But there is likely to be. I think there is more likely to be some consolidation of gold this year. Maybe a slight pullback before another push higher. But I think any push higher is going to be a little bit more controlled, because we have, we are very, very, we have seen such a big rise in such a short space of time. So, yeah, I think again, just whilst at the moment you do need to remain bullish, don't start thinking, oh, I can just buy because it's going to 6,000. It's very much be aware of what the market is communicating to you. Okay. Do you provide EA or recommend any trading bot? No, I don't provide EAs or trading bots. Mine is very much through support and resistance and understanding market behavior. Okay, guys. So, any questions on that in regards to the higher time frames? This is a daily context, so this is more your swing trading, being aware of the levels in terms of the overall market context, and where support and resistance might become, where the levels that we need to break to see those sort of deeper corrections. Any questions around that? With the emergence of AI, is this a realistic way to continue trading, or do you think it should remain skill based? Do you mean, Kimberly, that people should trade through using AI, or do you? I mean, personally, I think AI is going to change the way we trade. I don't think it's going to replace the way we trade. Support and resistance is still going to be support and resistance. I still think that humans, there still needs to be human involvement in trading. I don't think you're going to be able to go into Chat GPT and just say, put my portfolio together for me, or can you trade for me, or what should I do here? It might be able to advise you, but ultimately you still need to make those decisions. You need to still understand your own trading psychology, your own trading goals. So whilst I think AI will influence trading and it will change trading. I think you still need to understand the fundamentals, and I still think there's a huge element that will remain skill based from a human interaction point of view. Um, Zeshan, I want to know the market will come back to 4,400 again this week. We'll go and have a look at that in a moment. 4,400 is what's that? Yeah, that's a couple of hundred points again. Like I say, we'll look at it on the lower time frames, Zeshan, and then we can talk about that. Swing trader view, how to trade asset, which it does going higher, Benjamin. So from a swing trader, how to trade an asset which is going up. Again, unfortunately, in trading, you have to exercise a lot of patience. Okay, so from a swing trader point of view, identify your swings, identify your support and resistance. Those are the areas that you have to trade in the market. You have to just wait for the market to come back to those areas. Unfortunately, there isn't anything else that you can do. You have to wait for the correction. You have to wait for the swing to develop. You have to have clear entry exit criteria for your trade plan, and then you act upon that. Okay. Right, so let's go down a couple of time frames so we can start looking at the levels that people can actually get involved in the near term as well. So we're going to go as we're going down the level. So that's sort of like your higher time frame stuff. So that's sort of like for your swing traders and maybe your sort of longer term investors, and just to get an overall view of the areas to keep an eye on as we progress throughout the year for the overall context of the market. But as we move down the time frames, now you're going to start getting into your speculative traders time frames. You know, you're going to need to be more active. You need to be aware of support and resistance. And this, when you're a speculative trader, right, you need to understand that your viewpoint is different. You are trying to profit from the movement in price. Now, gold, the price is just going up, as Benjamin said. Okay, so how do you take advantage of an asset where the price is just going up? And the fact is, you have to be patient and you have to wait for the market to come back to you, because you do not want to sell a market that is just going up. Okay. Um, you need to identify that, or you've identified by saying that the market is just going up, you've identified that the market is ultra bullish. Therefore, you want to stay on the long side as much as possible, or really, you have to stay on the long side until the market starts breaking those levels that we've just spoken about in a higher time frame, which will change the context, and then you can maybe switch to looking for some lower time frame shorts. But all the time those levels are intact, you need to stay on the bull side, because the higher context is with the bulls, and therefore your high probability trades will be on the buy side. So you need to exercise patience, and you need to identify the right areas in the market for when the market pulls back. That's when you enter. Okay. If you just start trying to buy because you think the market's going up, that is when, where do you place your stop? You're just taking trades for the sake of it, and that's when you're going to lose money. So you need to look at the support and resistance on the lower time frames. Okay. So again, if we just look at this area here, we're looking really obvious area just here. Um, Again, okay, so you've got found support here. That was a swing area, and it was also tied in with a resistance area here. Okay, so you've got liquidity in this area here between 4,395 and 4,420. Okay, so who's it asked? So Zeshan says, I want to know, would a market come back to 4,400 again this week? Nobody knows. I mean, let's be honest, nobody knows anything. Okay, but if the market, and I always try, and again, you've got to try and think about the markets as probabilities, and always talk about if and when. Okay, or if and then, sorry. If the market pulls back to 4,400, then that offers a really good opportunity to buy. Okay, because you can see there it has held as resistance and it's held as support. There's liquidity there, there's institutional activity. Therefore, if the market pulls back to that, then it offers a good opportunity to buy. Okay, so uh, from your questions, Eshen, will the market come back? At the moment, there's no signal that the market's going to come back. Does that mean that it could change? Of course it could change. Donald Trump spoke about Iran reaching out for a meeting. If that happens, then tensions ease there. You know, if something happens in Venezuela, tensions ease there, and all of a sudden the Fed come out, or earnings season. All of these things, if these factors start lining up, which actually will make turn the market into a bit more risk on environment, then you're going to see a pullback in gold. Um, in which case, you need to be ready to take advantage of pullbacks into your 4400 area. But if the tensions continue to increase, if America strike Iran, if there's increase in tensions between the US and Venezuela, or the US and Europe over Greenland, or there hasn't been much talk around Russia, Ukraine. All of these sorts of things you need to be aware, because if they continue, then the market could just continue higher, okay? And unfortunately, if that happens, you can't just buy because there's no levels to buy. You're buying on a gut feeling, you're buying on a whim, and just hoping that the market's going to continue. Another thing, but here's another thing, okay? An if and then scenario. Okay, so you can set orders to buy in this area. You can set alerts so that when the market enters this area, you can then look for strategies as part of your trade plan to get long. But another if and then scenario, okay? So if the market continues higher because all of these geopolitical tensions continue. People continue to look to gold as a safe haven, and this pushes higher. Well, then we have another area that we could look to get long, because we would then have retests of this area of liquidity here, which is previous all-time highs. Okay, so you've got an area of a strong resistance which has been broken. So if the market continues higher, this could then actually offer a good opportunity to get long on any retest. Um, uh, you're hoping that we break 4,800 today, Sheriff. I think 4,800 today is a very ambitious target. 200 points in a single day is very ambitious. At the moment, the daily ATR on gold is only what is it, about 80 points. So we're already trading higher today. What was the low? We're already trading 80 points higher on the day. 80 points is the average range on gold. So therefore, to get another 200 points, you've got to ask yourself, is that realistic? Okay, not saying that you don't break 4,800 at some point, but just again, be aware of the volatility, be aware of the market, and set your expectations realistically. Unless there's something that really shocks the market, we don't see 4,800 today. Um, Yeah, Marcus, exactly. All this geopolitical stuff will create volatility. What is your trading system style? Do you use ATR to see a volume liquidity manipulation wick? Do you use single prints or no wick candles? When do you absolutely don't trade? Okay, really good questions here, Robbie. And Clau also asks, do I use stop loss? Where do you place it in relation to your trade? Yeah, some really good questions here. V, yes, I'll look at that level when we move down. So my trading system style, again, probably better explained, just to keep it on track, better explained in previous webinars, recordings. Very much support and resistance based around identifying institutional liquidity, exercising the patience to wait for the area of the market to move into those areas. Market moves based on institutional liquidity, okay, not on a particular candlestick pattern as such. Your candlestick pattern or your entry techniques, it's institutional liquidity which drives the market through support and resistance. Uh, I look for what you call a manipulation wick. I would call a liquidity grab. Yes, I do try and identify those as well. And do I use single prints or no wick candles? I use all candles. I use all price action as information. All price action is information. When do I absolutely don't trade? If the market, again, if the not going off topic here a little bit, but if I have I generally trade on the hourly. If I see a chart like that, which is just sideways and there's nothing really to do, then I don't trade it. Other than that, what I'm doing is I'm looking for the levels in the market which are going to offer me good opportunities to trade. Okay. Uh, Klaus says, do I use a stop loss? 100% of the time. You must use a stop loss. If you don't use a stop loss, there's so many questions that I ask. How have you defined your risk if you don't, especially as a speculative trader, right? If you're looking at an investment, if you're an investor or a longer term horizon point of view, you calculate your risk slightly differently, and you hold, like, it's a slightly different conversation. But in terms of speculative trading, you must use a stop loss, because if you don't, one, how have you calculated where your what your risk is based on in the first time? How do you know what your risk is in the market overall? And two, you are one piece of unexpected news or one unexpected movement away from blowing your account and doing some really serious damage to your account. So I see some people sit there and say, I'm monitoring it, and I have a visual stop loss. That's somebody who just isn't willing to take a stop. And if the market moves really quickly, you can do so much damage to your account. So yeah, I sit there and say you have to use a stop 100% of the time. Personally, that's my opinion. And where do I replace it in relation to my trade? It's a really good question. So when I'm looking at my support and resistance, so let's, for example, sit there and say, okay, I'm going to trade this area around here. Okay, so I've identified my area. What I will do is I go, right, okay, so the top of that zone is sort of 44.20, the bottom of that zone is 43.95. Okay, so it's 44.18. So let's round it up to 44.20. I would place my order to buy the market at 44.20, and I want to have my stop below that zone. Okay, why do I want to have my stop below that zone? Well, that zone is telling me, basically, that's where I think there is liquidity. That's where I think there's institutional participation based on previous price action. If the market breaks that zone, then what that's telling me is there is no more institutional liquidity there anymore, and therefore I don't want to be in that trade. It invalidates my trade idea. Therefore, I want to come out. Therefore, that's where I put my stop. So I would have my entry. If I just change that to a green for an entry candle, so that's where I would have my entry, and I would have my stop, not like literally at the bottom of that zone. Why would I not have it at the bottom of that zone? Multiple reasons. One, Robbie mentioned about manipulation. We've spoken about liquidity grabs in previous sessions. It is a phenomenon that happens in the market. Institutions do it. So I need to allow for a little bit of room in that. Support and resistance in and of themselves are subjective. Okay, so I see that as the zone. Somebody may see it slightly different. I need to allow for a margin of error. I need to allow for a little bit of volatility. So I, generally speaking, would have that sort of stop around in gold's example, around about 10 points further below. So I'd have my stop around 43.85, around there. So just enough room that if the market came down, I've got a little bit of room for margin of error. I've got a little bit of room for a liquidity grab. Is your stop loss fixed by pips, or it depends on your strategy? It is fixed by the it's a fixed number of pips in relation to the asset class that I'm trading, the instrument that I'm trading, and the time frame that it's on, the volatility of that time frame and instrument. So, for example, if I insert an indicator, I use the average true range. Okay, 14 is fine. That's your average true range. Okay, so what I do is I look at that. I look at the peaks on the volatility, on recent volatility. That's sort of 50 points. Divide that number by 2, that's 25. That's, generally speaking, the width of the zone, which is right, 43.95 to 44.20. Therefore, that's 25 pip range. And then I would probably, divide that number again by 2, and that's the sort of, like, general speaking, the distance that I want to put below the zone to place my stop. In regards to targets, you want at least 1-to-1. In this case, I probably would target sort of back up towards these highs here, this high here, which is 44.95. So I've got potential 75-point target. What have I got? I've got a 35-point stop loss. So I've got just over 2 to 1 trade, something like that, and that to me is okay. So as long as you want minimum 1 to 1 risk to reward, or higher. Sometimes you can hold runners because if you think this is going to go even higher, that's fine. Then you can sort of scale out and hold for a higher risk to reward ratio. Absolutely fine. That is my style of trading. Okay. That's the way that I approach the markets. That's how I base my trading decisions. And again, likewise, if we push higher, what would I do? I would look to buy retest of this area at 45.50. This zone is only sort of 20 points wide. So again, I'll probably still have a sort of 30-point stop on that. So 45.20 as a stop. And my target would be based on whatever the price action here. I would look for at least 1 to 1, and potentially higher. Okay. Um, yeah, exactly, Lisa. You can manage the market regularly and analyzing to move your stop loss to maximize profit. Of course, you can use trading stop losses. You can scale out to of your position and stuff like that as well. That's all fine. Um, Sharif says, any chance you break 4,600 today? We have already traded above 4,600, I believe. Have we? Yeah, we've traded at 46.01 today. So we have broken that. Do we see sustained price above there? Yeah, potentially. I don't know for sure at the moment. If we go down to higher time frames, sorry, down to lower time frames, we can certainly look at that. So as we move down the time frames, you've got to understand as well that the volatility decreases, and therefore you have to adjust your your stops, your targets accordingly. Okay, your risk should still remain the same in terms of like whatever your overall risk per trade is. Generally speaking, people use 1% as a rule of thumb. But if you use 1%, whether you're trading on a 4 hour, daily, 5 minute, you should always risk the same amount per trade, especially as a speculative trader. Um, all that happens is that the volatility drops, therefore you use tighter stops, you use smaller targets, and it's the ratio in terms of capital allocated to each trade is exactly the same. Okay, does that make sense, guys? So here, what we got here. Okay, so at the moment, obviously we haven't. This was like a 4 hour time frame. So I was saying that if we got like a higher a move higher, then I'd potentially look to buy this area. At the moment, I wouldn't. However, let's just delete some of these. This area down here is the area that we looked at originally, and that area still looks good on the hourly chart. And again, you can refine your entries a little bit here. I would argue against refining too much because you're going to miss a lot of trades. But again, this one is 43.90 to 44.05, something like that. Okay, so that would be your entry on a 1 hour rather than I think it was 43.85 to 44.10. Was it? I can't remember what it was on the 4. Let's see. It is in those sorts of areas. So that's one area. Again, this is unlikely to hit today. That's a big drop. So you can keep that on there as a potential level of interest over the coming session. That could hit end of the week. That could hit next week. It's still an area. But if we're looking at the market today, okay, let's just delete some of these for trade opportunities. Okay, and then we'll look at this one, and then we'll go down to like a 15 minute, and we can have a look at that because I really appreciate you've only got about sort of 10 minutes left of the session. That's one area. Okay, another area is this area here. Okay, again, we've broken out here and we haven't retested this area yet here. Okay, so that is an area. Again, overall context of the market is bullish. We've hit the daily range for the day. There is potentially that we're going to see a pullback today, but the overall market is bullish. Where do we want to buy? Where are there opportunities to buy? If we see a pullback, then we look to get long from this area around 4,500, 45.15. Again, okay, you can enter at 45.15, sort of around there. Your stop, let's just use the red thing for stop. Um, again, okay, so we've moved down the chart an hour, hourly. So go to the peaks. That's around 30 points. Your zones on the hourly want to be about 15 points wide. Your stop wants to be around 20-25 points from the top of that zone. So again, your stop's going to be around that 44.90 area to allow for price to come back into that area and have some sort of liquidity grab. Any error in terms of stock placement, any volatility spikes, anything like that. Okay, so again, support resistance. We're bullish on gold. Pullbacks to 4,500 to 4,515 offer a really good opportunity to get long. If that happens, then you are ready to go long, and there's your criteria. And again, you can target up towards the next sort of swing low, which was like, we've had some sort of swing here. So that target is a sort of 45.60, 45.55, 40 point start, a 40 point target. What did we say? 25 point stop. So therefore, we've got a 1.6R risk to reward trade. Absolutely fine. Again, above that 1-to-1 offers a really good risk to reward opportunity for a trade on the lower time frames. So stop loss is based on it's based on both, Benjamin. So is it based on analysis or is it based on points? It is based on your analysis of the support. And this is my style of trading. Okay, so you might have if you have a reversal, if you have a reversal technique in there, you may wait for price to come into that zone, wait for the reversal technique, wait for the reversal pattern to set up, have your entry and have your stop below that reversal pattern. Personally, I have my analysis, which is my support and resistance zone. In this case, it's a support zone. And then my stop loss is based on the volatility using the ATR and having linking that to have an appropriate stop below that zone. So the analysis gives you the zone, and then the volatility using the ATR gives you the number of points that you want to have your stop placed at. Hopefully that makes sense. Okay, so that's your 1 hour chart, and then let's, as I say, because I appreciate we are running out of time here. So let's go down to the lower time frames to again just have a look here. So V mentioned the level on the 15 minute possible level 45.90. What do you think? 45.90. So 45.90. I mean, this is here. I mean, it seems to be finding some resistance here, V. So I don't know whether you were talking about as a stop, sorry, as a sell or as a long. Obviously, at the moment, it's found that double top at the moment. I wouldn't short this um, because it's against the overall trend. Okay, um, you're at all-time highs. Contextually, you really want to be looking for buying opportunities. So again, you've got here again, refining this a little bit, is still in that sort of same area. Here you've got a little gap. Notice this gap here. This is. I'm not going to go into details here because again, I haven't got time to go into it. Maybe we can cover this in another session. Gaps generally tend to get filled. They're market inefficiencies which tend to get filled. So if the market pulls back into this area, it may want to just fill that little gap where there's been no price happened. Okay, so the market may want to come back into this area again, provides a good opportunity to come long, to go long. You've got a gap there. Market feels it. It's at a support zone. It's with the overall context of the market. Really, really good opportunity to go long there around 45.10. Okay, so again, a level that you've got there, 45.10. Stop below that zone, and you can target. So again, just a slightly refinement as you go down the time frames. You can become a little bit more specific. You can get a little bit tighter entries and targets. But like I say, equally, you've got to be careful not to over refine. Um, in regards to 45.90 V, what I would sit there and say again, if so Sharif asked if we break 4600 today. If we see that sort of price action, let me just move it over here. If we see that sort of price action whereby we see price on the lower time frames break higher above 4600, let me just used the wrong thing now. Above 4600. Can I drift above 40? No, how do I do a line? If we see price break clearly above 4,600, shape, here we go. No, arrows. So if we see this, no, excuse me, sorry. Let me let me just delete that. I don't. Anyway, sorry. All right, let's get through this. If we see price break up here cleanly and then pull back into that 4,600, then it can potentially offer an opportunity to get long. Um, so I would wait for price to break and then retest this area to get long. So Robbie says gap on CME at 45 to 8. Exactly, Robbie. So you can see that gap on the chart here, and that offers a really good opportunity to get long if we see those sorts of pullbacks to that area. Okay, guys, apologies. We are out of time for today. So hopefully, you can. That's provided you some really good information for lower time frames, but also like higher time frame contextually for going forward in 2026 as well. As we're going to wrap up the session, we would love to hear your feedback. As the events team has said, please can you take the time to fill out the survey that will appear on your screen, and also register for the next webinar, which is all going to be around VWAP as well. All right, guys. Have a great day trading, great week trading, and I really look forward to seeing you on the next session of the Trading Vault. Happy trading, everyone, and Happy New Year again. Thanks for coming.